The election is over, but did it really change the stock market? With two main political parties having different ideas about money, you might expect the results to cause big shifts in stock prices. But surprisingly, history shows that the party in power doesn't always make a big difference. Let's dive into the numbers and uncover why the party in control may not be as important as it seems when it comes to the financial markets. US politics and money plans. At first glance, the ideological divide between the two main US political parties, Democrats and Republicans, DJIA, might suggest that elections could lead to sharp changes in stock market trends. Democrats are typically associated with policies that focus on increased government spending, social safety nets, and higher taxes for the wealthy, while Republicans tend to favor lower taxes, reduced regulation, DJIA limited government spending. In theory, these fiscal differences should create distinct reactions in the financial markets, especially in sectors that are sensitive to government spending, tax policies, and regulation. For example, industries such as healthcare, energy, and technology may respond differently depending on which party is in control, especially if one party's policies are perceived as more favorable to business or economic growth. However, when looking at historical trends, the relationship between election outcomes and stock market performance is far less clear-cut. How elections impact the stock market. To assess the impact of US elections on the stock market, particularly the Dow Jones Industrial Average, DJIA, swing, we need to look at a broad swath of data spanning several decades. One method used to gauge this impact is by comparing the level of the DJIA 1 month before the election, typically in early October, to its performance 6 months later, around the end of March. This time frame is useful because it captures the period when the election's outcome is still uncertain, but provides a clear view of the market's reaction to the new political reality once a president has been sworn in and the new Congress is in session. What we see in the data might be surprising. Across various election cycles, the performance of the DJIA did not show a consistent trend that favored one political party over another. Instead, market performance seemed to be influenced more by external factors such as global economic conditions and domestic crises than by which party controlled the White House or Congress, the case of unified governments. A unified government happens when the president and both houses of Congress are controlled by the same party. This was more common in the past but has become less frequent in recent years. Looking at recent examples, when Joe Biden became president in 2020 with a Democratic-controlled Congress, the stock market, DJIA, went up over 17% from 28,150 in October 2020 to more than 33,000 by March 2021. Similarly, after Donald Trump won in 2016 with Republicans controlling Congress, the market rose by 12% from 18,250 to over 20,500 in the first few months of his term. However, in 2008, when Barack Obama took office with a Democratic-controlled Congress, the stock market dropped sharply from 10,800 to 7,500 due to the global financial crisis. The market downturn was mainly caused by the recession, not the political situation. Split Congress and its market impact. A split Congress occurs when the presidency and one chamber of Congress are controlled by one party, while the other chamber is controlled by the opposing party. Historically, this scenario has also produced mixed reactions in the stock market with no clear trend favoring one party over the other. In 2018, President Trump had a split Congress, with Democrats in control of the House. During this time, the DJIA dropped nearly 3%, from around 26,650 in October to 25,900 by March 2019. This shows that the market was likely influenced more by things like trade issues with China than by the political situation. In 2012, even with a split Congress under President Obama, the DJIA went up by 7% from 13,500 in October to 14,500 by March 2013. Similarly, in 2010, the DJIA rose by almost 14%, from the 10,800 to 12,300 DJIA. Logically, even though Congress was divided, Republican presidents with Democratic Congresses. Interestingly, when a Republican president faces a Congress controlled by the opposition party, the Democrats, logically, the stock market has sometimes reacted positively. A notable example occurred in 2006 when President George W. Bush's reign, a Republican, faced a Congress controlled by the Democrats. During this period, the DJIA rose by 5.5% from around 11,700 in October 2006 to 12,350 by March 2007. Similarly, under President George H.W. Bush in 1990, the DJIA climbed by 16% during a period of divided government, with Republicans in the White House and Democrats controlling both chambers of Congress. The DJIA rose from around 2,500 in October 1990 to about 2,900 by March 1991. What does this all mean? After looking at decades of data, we might expect a clear link between political control and the stock market, given the differences in party policies. However, the evidence shows that which party is in power doesn't have a big or consistent effect on the market. Bigger factors like economic crises, recessions, and trade wars have a stronger impact. While election results and party control might affect the market in the short term, they don't seem to control long-term trends. The U.S. stock market is shaped by many factors beyond the political party in charge. In conclusion, even though people often think the party in power affects the stock market, history tells a different story. The market is more influenced by the economy and outside events than by which party is in control. While elections may cause short-term changes, the market's long-term trend depends more on global events and the economy. To predict the market, voters should focus on the bigger economic picture, not just political parties. So, what does this mean for investors? While elections can cause short-term shifts in the market, the long-term direction of the stock market is driven more by bigger factors like the economy and global events. If you're basing your investment choices on politics, it might be time to rethink that strategy. What do you think? Do you believe the party in charge affects the stock market, or is it other things that matter more? Drop your thoughts in the comments below. If you liked this video, be sure to hit the like button and subscribe for more content. Thanks for watching.